Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi, I'm Vinay Joseph, the Chief Investment Strategist at Standard Chartered Bank India, and welcome to another edition of Views from the Street, bringing you market views and insights on how you should look at your investment from industry veterans and market experts. And today we are joined by an industry veteran who needs no introduction, Mr. Bharat Shah, Executive Director, AS Group. Thank you, Bharat Bhai, for joining our podcast. Let's start with the most pressing question on investors' mind. Does the budget show continuity in policy direction from the government and benefit growth assets like equity?
Without any doubt, I think the first budget, which was like a breakaway budget from the earlier tradition, was that of 2021, where it very clearly showed departure from the past in a major way, and some of the socialistic overburden which has been part of our budgetary exercise very clearly that was shed off in the 2021 budget. In 2022 budget, I am delighted that we have continued on the path of the growth, capital formation rather than expenditure. Therefore, prioritization is not expenditure but investment, and therefore value creation on a long-term basis. And despite many temptations, I think budget has retained the core integrity of accelerating the growth rate of economy rather than freebies, So I believe as a country, as an economy, both, we are at a takeoff stage. And I think that is in a very positive direction. And the takeoff, to my mind, for a long period of time, as well as the quantum of change is substantial. Therefore, after a long time, we are in a structural long-term improvement and continual improvement and rise in the character of economy, and that in turn will reflect into the performance of the quality businesses and hence into their prices. Therefore, the way the country is getting digitized, way the businesses are digitally getting improved, the way the payment system in the country has been revolutionized in just 4 years' time. Also, PLI-led manufacturing, new renaissance hopes. Also, banking system has now been healed. All the fractures have been repaired, and banking is in a very healthy shape after a lot of difficulty for a period of time. So I think we are at a perfect stage where with the rising capital formation, and slowly but very clearly signs are there where the private capital will have to play the bulk of the role. Government has shouldered that responsibility despite limited budgets for a length of time. But now that real crowding in of the private sector investment, virtuous capex cycle, and therefore rising rounds of the growth and the quality of growth, all are in evidence. And therefore, I believe it is not a brief 1 or 2 or 3 years, but not even a decade. Probably it is more like a couple of decades of virtuous long-term rise. Of course, any such secular rise would have in between attenuations and volatility of ups and downs. But through that volatility, I think I would say safely that we are entering a couple of golden decades of high quality growth as well as high growth.
Thank you, Bharat Bhai. Taking your question on volatility, we have seen a little increase in interest rates lately for the market, and inflation is also impacting segments. How do you see that playing out, and which different segment, how it impacts different segments of the equity market?
I'm not unduly worried about the rise of the recent little rise in the cost of capital. I think cost of capital in general has been one of the lowest that I've seen in more than 3 decades of observing Indian markets. When did we see housing loans available at 6.3 and 6.4% ever? But they are available today. There may be at margin some rise in the cost of capital, but I don't see any dramatic tearaway kind of a rise. Globally, the capital is in excess supply. Bulk of that capital earns practically no return or negative return, and India has shown willingness and ability to attract that capital, both on the private capital, venture capital side, through innovative finance on the debt side, with the sovereign bonds getting listed and now the green bonds which are proposed to be issued. I do not believe that there can be any dramatic rupturous change in the cost of capital. There may be some small increase here and there, but it is within the compass, and therefore I'm not really worried. Priority is growth, sustained growth, and that has to be kept in full radar. And while cost of capital is not the only determinant of that, but it is an helpful determinant in capital formation. So I think consumer finance, businesses and corporate finance, industry and infrastructure finance, and the commercial finance, given the fact that exports are performing phenomenally, I see all the branches doing well. There will be a good demand for credit, and there is adequate liquidity, and therefore, while there may be immediate rise in the bond yields yesterday, but I don't see it as a huge concern on a long-term basis.
Thank you. My final question, since you have been in this markets for so many decades now, going into this new decade, what are the themes which you think will accelerate growth and which investors should be positioned to gain maximum leverage ahead?
Investing is bottom-up stock picking. It is not riding a theme or a trend or an idea. All that is very popular part of investing folklore, to try to identify some theme and a rising tide and ride along the tide. In my opinion, that's a very dangerous way of thinking about investing. Investing remains bottom-up stock picking, business by business. Find a quality business which has potential to create value, sustained value. Find managements which have ethics and capability both to ensure that the value creation function is enhanced. Ensure that there is enough size of opportunity so that there is a growth engine, a compounding growth engine, and ensure that the quality of growth is superior so that growth is not cancerous growth but a value creating growth. And we as investors have to be able to judge all of these reasonably well and arrive at a judgment or a conjecture of value, and keep revising the opinion if need be in light of new insights and new understandings. And do all of that with discipline, without getting carried away by the market machinations, market excitements and depressions time to time. That is the job. But that said, I think if I have to borrow from Buffett, I feel like a kid in a candy shop. That is the kind of opportunity. Consumers, durables, luxury, discretionary, all will do well. Healthcare, pharma, specialty chemicals, specialty agro nutrients. We have a great strength, and there is a rising tide for a long term in those areas. Lenders I already talked about. Balance sheets are held. Capex cycle is in evidence, and there will be increased demand for credit on all sources, and therefore there is an opportunity. Insurance of all kind, health, life, general, all that will have a long highway of growth, compounding growth. Capex related businesses which help and enable that also will be gainers. Businesses like cement would have long-term rise backed by infrastructure and related demand, So it's like a harem where too many choices are available. I don't think we should get carried away by any theme. We have to do our diligence and focus on individual businesses with a hard-nosed up understanding and valuation and play it by that.
Thank you, Bharat Bhai, for joining our podcast and giving some really time-valued advice on how you should look at your investments. Thank you, participants. In case you like our podcast, do subscribe to it on the channel. Thank you.
Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.